Assalamu alaikum and hello. My name is Dishan Hassan and I'm the tutor of Advanced Audit Assurance. I've been teaching this paper since last more than 7 years now, and approximately my students' passing rate is more than 80% in this current attempt, whereas ACCA passing rate was 31%, which is ACCA released for March and June exams. Whereas my students, accountancy students, passing rate for AAA was above 80%. Okay. Now let us. I open this examiner report to do some analysis and to you the and show you guys that what mistakes are actually causing you a failure in this exam. So let's start with it. First of all, there are general approach to triple examination. That's a exam structure which everybody knows. Let's ignore it and move ahead. Section A question: infinite company, 50 marks were there. Now we are starting from here. Candidates are presented with the following information as they begin the question. It is 1st July. You are a manager in Pascal and Co, a firm of chartered certified accountants, and you are responsible for the audit of the Infinite Co, a new audit client with a financial year ending 30th September 2005. The Infinite company is the owner managed business, family business. Well, many of the students mentioned over here that it is a detection risk and all. Well, you got zero for this. Why? Because it didn't ask you audit risk. It didn't ask audit risk. It asked significant material misstatements. Significant material misstatements. So you got zero if you said that it is owner managed business, so they can be biased and all. You got zero because it's not relevant to the scenario. Okay. Anyways, the company owns and operates theme parks, the Infinite Park, which includes theme park rides, arcade style games, and food and drink outlets. Well, the entity in this scenario was a new client to the audit firm. See what examiner is saying over here. With the core business being the ownership and operation of the theme park, including arcade style games and food drink outlets. Now, see over here with the part which I highlighted. Candidates should not note that they are not expected to detailed industry specific knowledge. Industry specific knowledge was not required when answering questions in this examination, and the scenario will always have enough information to enable sufficient specific risk to be identified and evaluated to achieve full marks. Now, several exhibits were provided to candidates them to develop an understanding of the specific issues relevant to the audit. These were as follows. Now, these were the uh, you know exhibits partners email in which you have received Brian Fox, the audit engagement partner, in relation to the Infinite Co and Mediate Co. There was in background information related to the Infinite company website, giving background information about the company. Meeting notes from a meeting between Brian Fox and the finance director of the Infinite company. Preliminary analytical procedures, summary of key issues arising from preliminary analytical procedures performed by the audit team, and Medico, a copy of the client acceptance assessment performed on Medico prior to the audit procedure. Now, see what examiner state over there that unless specified otherwise, all exhibits should be considered when carrying out risk evaluations, and candidates should ensure they carefully read the partner's email for uh, should ensure they carefully read the partner's email for any specific guidance in relation to how the information should be used. So, as I mentioned over here as well, though it is necessary to read and plan full question for this requirement. So, the correct approach is firstly read the whole scenario first and then start attempting the question. Okay, so that you can link various part of the question at the various points. Now it is recommended that candidates review all exhibits while planning their answers. The examiner also saying that planning their answers to the question, but as mentioned, should ensure they take note of any guidance given by the examining team in terms of which exhibits are relevant to each requirement, thus allowing for more detailed analysis and focus on specific information where relevant. Now, it is often the case that there will be interactions between the exhibit which will impact on the analysis performed by the candidates. See, examiner saying this. Candidates are encouraged to spend adequate time planning and aim to obtain a holistic view and understanding of the issues present in the question. Now, here it is the introduction to the question. The current date is 1st July X5 and client has a year ended of 30th September 2000 X5. The scenario is set 3 months prior to the year end with the audit taking place sometimes after the client year end audit take place. Okay. So this indicates the planning stage of an assignment with the audit taking place in October or later. So this is normal and does not indicate there is a lack of time to plan the audit. Remember it. Number two, infinite company is a family owned and managed. This means company is not listed and is not required to follow corporate governance best practice. Now, so infinite company operates a theme park and has suffered an impairment of some rights due to lack of maintenance. So now here the blunder made by the students. What are the blunders? The company also hold on a revaluation model. Number of candidates demonstrated lack of general understanding of IS 16 property plan and equipment, either stating it was incorrect not to depreciate land or that it must be considered for impairment under IS 38 intangible assets every year. This was a straightforward risk that land value had not been considered for several years, and under IS 16 the valuation must be kept up to date. Two done. Third one. Infinite company had included general provision for unexpected costs which had increased during the year. A significant number of candidates failed to identify that the general provision did not meet IS 37 and contingent assets and therefore demonstrate a lack of understanding of basic financial reporting knowledge with a number stating provision was likely understated. Another blunder. Now it is important to note infinite company is an initial audit engagement. The requirement for A is to evaluate risk of material misstatement and not audit risk. So therefore, comments relating to an increase in detection risk due to lack of understanding of the client would not be relevant. Marks are were available for discussion of the risk of errors in opening balances or adopting consistent accounting policies in consecutive years. So now, see, it is important to note that there are specific instructions where attention is drawn in the audit partner's email. The information details Exhibit 2, 3, and 4 are required in order to address the risk of material misstatement in Part A and for the evaluation of the indicator of impairment in Part C. The partner's email clearly defines Exhibit 5 is required to formulate an answer for Part D. So you do not need to consider Exhibit 5 for earlier requirements. With this context in mind, now you should then consider requirement while working through the remaining exhibits to enable tailored response to made. Now, first requirement issues. Evaluate the significant risk of material misstatement to be considered in planning the audit for the infinite company for the financial year ending 30th September at 524 marks available. Now, see, the requirement is typical in volume and nature to many planning questions and examines a major area of syllabus. It is important to notice that the requirement asks for an evaluation, not simply a list of risks, nor a strategy or procedures to address those risks. The examining team are testing whether candidates can understand how and why a risk arises and the implication that this has on the financial statement or the audit itself. They are looking for an assessment of materiality, demonstration of knowledge, of the underlying accounting rules and application of that to the scenario to identify potential impact on the financial statements. Now, see, the, an issue that arises repeatedly is that candidates are attempting to find, see, attempting to find 12 risks for a 24-mark questions and conducting later or no in-depth analysis of them. This will not be able to attain a pass mark. This means some of the risks stated in this candidate answers will be speculative or not significant and therefore will not obtain credit. That's I repeatedly told my students in my classes, and many students were like, "Sir, you're wrong, and your approach is wrong." Other teachers told us that way, etc., etc. Your answers are too lengthy and all. See, I was right, an examiner backing my statement. Now, candidates should be aware of the published marking guide for six risk questions and understand how marks are credited. Each risk generally has a minimum of 3 marks. See, uh, each risk generally has a minimum of 3 marks. Generally, 3 marks, right? Minimum 3 marks are 3 marks are attached to it. More complex risks. Now, see over here, more complex risks carry additional credit. That means some risks are worth more than 3 marks. Materiality and calculation marks are over and above the marks available for the discussion of a risk. The marking guide published for this question has 14 areas of risk, some of which are deemed more basic financial accounting issues and therefore carry lower marks and therefore should be more easily obtained by candidates. That was the thing. Many students did criticize, oh me, that's why you are writing too much of a lengthy marks. We just need three small paragraphs to obtain 3 marks per risk, and that would be enough. Blah blah blah. You are writing too lengthy, and I said no. This paragraph. This has the see it giving you a lot of information. An examiner do not give anything to waste your time. It has something to do with your scenario. You will get extra marks for it, but few students were there like they were criticizing me on it. Now see, my point is proved. Examiner is backing me. This is the examiner article, and examiner is saying this. Now, the requirement asks only for significant risk of material misstatement, which means risks that are specific to the scenario, non-routine risk management to make estimates or subject to judgmental assumptions have the potential to give rise to a material misstatement. Speculative risk arising from routine transactions generally will not obtain credit. Candidates demonstrating strong professional skills will be able to differentiate between speculative and specific risk and not spend time discussing topics which will not obtain credit. Now, let us look about the exhibit 2. Candidates must remember when discussing risks that it is important to relate them to the scenario. I repeatedly told that there's this thing in my classes rather than discuss abstract or general risk, generic risk. You cannot assume risk by yourself. You should not. You cannot discuss general risk or those risks which you had wrote learned from your book textbooks. It need to be scenario specific. This is particularly an issue when discussing management bias risk. This is a key concept to understand for auditors as it can impact on judgments made by management in deriving their figures for the financial statements. Candidates must be able to demonstrate that they understand the concept of management bias and can identify in it in practice. The examination team are often faced with two standard candidate responses to management bias risk in section A question. There the client is listed, so management will be biased to keep shareholders happy, or the client is not listed, so the managers honors will be biased to keep profits low and save tax. The first statement doesn't include scenario specific reason for this conclusion and is therefore too vague uh, and generic. The second implies that all non-listed clients are concerned with aiming for lower payments in respect of tax. Again, this is a generic statement, and unless there is information in the scenario that specifically alludes to this, then candidates will not receive credit for making this point. In both cases, neither will be credited as an evaluation of management bias for a specific scenario. So candidates are told the company is a family-owned business, and then family members are actively involved in the day-to-day running of the business. The specific management bias point in this scenario is the ability of management to override controls. So to score more than a half mark for the identification of a bias risk, this will have to be evaluated by candidates, and how it will be evaluated. Suggested explanations can be lack of segregation of duties, disregard of laws and regulations. Scenario stated the rights have not been maintained on a regular basis, aged and lack safety features, evidence of bypass of controls. As the scenario states, there is evidence of access to company funds. Now, so beginning of the evaluation will score the initial mark. It should then be linked to the scenario, illustrate areas where this could potentially happen or appears to be happening. And this is reinforced by the specific examples in the scenario. There are example of risk stated above to enable an evaluation to made with specific reference to the question. Candidates might find it sensible to address management bias after they have analyzed the other risk in the question, not straight away. Third one, meeting notes, Exhibit 4, preliminary analytical review. Impairment of assets arose around the theme park rides that showed up lack of upgrades for modern safety features. Materiality of the ride should be calculated against the current year figure and not prior year figures. Many students did calculate it against the prior year figures. So this is a simple calculation. If this if the issue is the material risk of this statement, candidates need to identify indicator of impairment from the scenario. In this instance, is the aging of the rights and lack of safety features. Many of the candidates correctly identified relevant accounting rule, yet a number failed to fully state the rule and therefore failed to gain the full mark available. Again, next, falling from the impairment risk of the theme park rides, the scenario then details the risk regarding the revocation of the license to operate the theme park rides. This should therefore be deemed a potential indicator of going concern. There was a mixed response here, with many identifying the uncertainty regarding going concern, yet evaluating that there was a risk of the financial statements being prepared on a incorrect basis, which is unlikely, rather than identifying a potential lack of discussion in the notes to the financial statement for the uncertain. So this failed to earn additional mark for the evaluation of the risk. Next, land was held by under a revaluation model is not depreciated. The company is not depreciate land. It is disappointed to note a significant number of candidates state that it was incorrect not to depreciate land. And therefore stating the risk was that carrying amount of the land was overstated. So, well, this sort of blunders make me laugh. Sorry if you mind, and if you are among those. Now, revenue recognition was split into two main areas. The scenario detailed it was a cash based business and there was a risk of overstatement of revenue. Due to money laundering, there was a risk that proceeds from illegal activities could be added to the cash balance, potentially overstating both cash and revenue. The majority of the candidates correctly identified the risk and scored well. The second consideration of revenue recognition related to revenue being understated due to the risk from the theft of cash sales, which was particularly linked to the high volume of the casual seasonal stuff. It was surprising that marks available for this angle of revenue recognition were missed, with several candidates incorrectly discussing risk for errors arising due to the company moving to electronic payments and staff being untrained on how to operate the system. A minority of candidates incorrectly identified and described how revenue can only be recognized when a customer has physically ridden the theme park rides. Then we had the sale and leaseback transaction was a new issue which arose during the year with the company entering into the arrangement. In respect of the park buildings, the candidates struggled with the calculations here, and the trend marks available were generally not obtained. Generally, the risk was poorly answered, with candidates failing to score anywhere near the maximum marks available for the risk of misstatement. Management recognizing the transaction as a sale is incorrect. Instead, a right of use asset at the proportion of the retained carrying amount should be recognized along with the corresponding liability at the present value of the future cash payments. The accounting treatment is deemed more complex and therefore the risk is worth more than journal 3 marks per risk over here. See, now, the majority candidates correctly identified the treatment was incorrect, yet they scored poorly regarding the accounting rules and failed to score relevant trend marks that were available, such as a calculation of the amount to recognize as a right to use asset and correct calculation of the gain on disposal. Now, major blunders. A significant number of candidates demonstrated a lack of financial reporting knowledge by stating the risk of material misstatement linked to IFRS 8 segmental reporting. Company have a number of streams of income. The company is a privately owned company, and therefore segmental reporting under IFRS 8 is not applicable because it is a privately owned company and not a listed company. IFRS 8 is applicable to companies whose debt or equity securities are publicly traded. So candidates were not awarded credit where risk grounded lack of segmental disclosure was discussed. Legal case was contingent liability and general provision were identified in the scenario and several candidates failed to deal with them correctly. Many candidates failed to link the detail in the scenario and merely stated that liabilities may be understated even though details state that the level of the claims was unknown and therefore unlikely to meet the criteria of IS 37. No marks were awarded as the issues were would have been a lack of disclosure regarding the legal case in the financial statements. The general provision was poorly answered, with a number of candidates failing to identify that a general provision for unexpected costs cannot be recognized under IS 37 as it does not meet the criteria of accounting standard. Many candidates link the general provision to the legal case and stating the provision was understated rather than overstating as should not have been recognized at all. If the lack of provision was linked to the detail of the lawyer being an evidence of the director and that they may not be objectives in their advice, credit was given for the development and evaluation of risk regarding potential understatement of the liability. In Exhibit 4, the candidates' details of analytical procedures, candidates should remember that calculations are only credited when the result figures are discussed in their answer in the context of a risk. Simply calculating ratio will not obtain credit. The skill examined is the ability to calculate relevant ratio or trend to identify a risk or support an evaluation of a risk. It is that point that the calculation mark is awarded. Overall, this requirement was answered reasonably, blah, blah, blah. Let's move on. Requirement B, audit procedures to be performed on the impairment of the theme park rights. This requirement was well answered by a majority of candidates. Well described procedures given the model answer provide a list of procedures which are indicators of areas, blah blah blah. Let's move on. Uh, Requirement C, discuss the responsibility of auditors with respect to money laundering, evaluate whether there are any indicators of money laundering activities. The infinite go audits staff. The requirement will focus on the responsibility auditors have regarding money laundering to evaluate the indicators. Let's move till here. The most alarming issue highlighted in a significant number of candidate responses where candidates stated that suspicious of money laundering should be disclosed to those charged with governance. The audit committee, even though in this scenario, the company didn't have one. And a minority of candidates stated it should be disclosed in the notes to the financial statement or the audit report in the public interest. So this action would amount to the audit committee or a criminal offense of tipping of the client. And it is disappointing to see the number of candidates who fail to understand the difference between money laundering and fraud. So that was the thing. Moving ahead, using Exhibit 5, conduct a review of information contained in the Mato company client acceptance assessment to evaluate weakness in Pascal and co-acceptance procedures and recommend improvement which should be implemented. So there was a mixed response here, which candidates either answer very well or evaluate the weaknesses or stated general acceptance procedure to be performed and failed to respond specifically to the requirement. It was noted that number of candidates discussed the need to communicate with the previous auditor, which is correct, or a requirement for general consideration at acceptance. In the context of this scenario, the aspect of the acceptance assessment stated that the verbal clearance had been obtained, hence the previous auditor had been contacted. Number of candidates failed to recognize that the issue in this weakness was not that only a verbal confirmation had been received, and this should have been obtained in writing. Where candidates discuss the weakness specific to the scenario, marks were awarded. However, generic comments, general comments, which are not related to the scenario regarding communication with previous auditor did not meet the requirement and demonstrated candidates failed to successfully understand the requirement. Okay, so many candidates correctly identified that money laundering assessment was inadequate and provided weak evaluations as why it was too brief. There were several responses that stated details obtained from the owner and his wife were insufficient, yet they failed to identify that the auditor should have performed client identification procedures to involve additional individual, and this should have been extended by any shareholders holding more than 25 holding along with their other directors of the company. A number of candidates failed to identify this issue. Now, see in section B, this 25 mark question was said at the completion and reporting stage of an audit as of typical of our reporting questions. This is where the examination team see some of the strongest and some of the weakest demonstration of auditing competence from candidates. Stronger candidates often display strong practical skills, incorporating a good understanding of materiality and risk, a strong knowledge of the financial reporting which is needed to perform, and audit ability to distinguish between auditor and client information, and a premier understanding of the difference between financial statement and audit report and an audit opinion. So weaker candidates tend to lack of the underlying knowledge of the double entry accounting. Wow. And are unable to distinguish between client and the audit firm, between financial statement and auditor report, or demonstrate an understanding of the concept of materiality. So in requirement A, using the information exhibit 1, comment on the matters to be considered and explain the audit evidence you will find during your review of the audit working papers. Okay. Suc Successful candidates identified the new product capitalized as development cost was unlikely to meet the criterion IS 38, as the selling price is noted to be less than the cost incurred, and therefore would be loss making. To answer the requirement successfully, the candidate should take an approach of calculate the materiality first, M, identify the incorrect accounting treatment by the client, the T, state the relevant accounting rule, A, and the impact of the financial statement, your risk or the impact are. Say the new product is recognized as development cost under IS 38, and it was disappointing to note candidates who made to reference to pirate criteria while this is used as an acronym for candidates assist them in retaining the knowledge. Okay, a number of candidates incorrectly stated 4% of profit before tax was material, where it is below the benchmark of 5% and therefore not material. Calculating materiality incorrectly in a section B question will ultimately affect how candidates answer the impact on the audit opinion. This later requirement is normally examined separately, resulting in marks lost due to suggesting an incorrect impact on audit opinion. The warranty provision had declined in comparison with prior by 50%. Materiality was generally successfully calculated for this matter, and most candidates were awarded the additional trend marks available. The main issue here was that there was a reduction in the warranty provision, yet revenue had increased. This appears inconsistent as there is an exception. The warranty provision would increase in line with the increasing revenue. Candidates were required to identify this as being a potential management manipulation of the figures, and the auditors should adopt an increased level of professional skepticism. So, successful candidates over here scored well regarding the evidence expected to be on file in response to both matters and scenario. The evidence is required to be specific to issue an examples of evidence for the new product related to more general capitalization criteria. Now, in requirement B, stronger candidates calculated the materiality of the liability and fully evaluated the misstatement was not material for candidates to score maximum marks. The term not pervasive must be explained. For example, it is isolated to one issue and the financial statement as a whole are not impacted, where candidates merely say the impact is pervasive with no explanation, credit will be restricted. Candidates should then indicate the correct opinion to be given. In this instance, a qualified opinion due to material misstatement. Candidates should evaluate impact on the report in the basis of opinion paragraph, which is situated below the opinion paragraph, is used to explain the reason for the modification. So, examiner further saying it is disappointing to note number of candidates who continue to discuss the use of an emphasis of matter paragraph in response to this issue, which is wholly irrelevant, along with the number of candidates referring to the need for key audit matter their paragraph. Yet the scenario clearly stated client is not listed. And CAM, key audit matter, is for listed clients. C part, explain the implication of proposed sales of buyer's company on the completion of the audit. The final requirement required candidates to consider the implications regarding the sale of the company to venture capitalists. The auditor had not been made aware of the issue during the field of the audit, with the information only having been identified at the clearance meeting. This requirement was poorly answered, with a significant number of candidates failing to attempt the question or incorrectly stating it was either an adjusting event or an unadjusting event. Some candidates saying that financial statement need to be prepared on breakup basis, concluding because the company was sold was no longer a going concern. Some candidates also stated that it should be a part of a held for sale IFRS 5. A few candidates who did evaluate the impact on the audit mainly identified that there may be a risk of manipulation of the financial statement in order to show a healthier position of the company to obtain a best selling price. The main issue from the scenario is the auditors were not aware during the fieldwork, and the integrity of the management should be questioned. Therefore, audit risk increases due to the potential change in ownership from a management bias point of view. Management representation obtained should be considered in line with the increased risk surrounding management integrity and additional procedures to be performed around areas of judgment. Now, Requirement is using the exhibit 1 and 2, explain the specific inquiries you should make of body company management relevant to the company's intangible assets. Here, weaker candidates listed detailed substantive procedure to test intangible assets, yet does not meet the requirement as due diligence is limited to inquiries, and this being specifically stated in the requirement. Candidates who merely discuss audit procedures to test intangible assets and did not focus on the intention to the inquiries would not be credited. Candidates needed to make inquiries concerning the valuation and the significance of assets. Right. Now, generally, the depth of the answer was short of the expected from a professional level candidate. Candidates are advised to read the specific question requirement to develop a clear understanding of what is expected within their response. Due diligence is the area that should be answered well, and there is no double entry accounting knowledge being evaluated. Candidates should also be reminded that a due diligence is not performance of an audit. It is an audit-related service, can sit in a number of engagement categories. While the assignment uses a technique of a review engagement, it is likely it will be deemed an agreed upon procedures engagement, which is a fact-finding exercise and no assurance is given. Right? Weaker candidates further let me were merely identified. It's related to the ethical threats. Weak candidates were identify the threat with or little explanation. For example, the offer of the trip to attend the conference paid by the client, where candidates merely say there is a self-interest threat, yet do not link it to detail in scenario. No credit will be awarded due to lack of demonstrating knowledge of ethical threats which can be applied to the specific scenario. A number of candidates do not read the scenario sufficiently and discuss the self-review thread linked to the corporate finance advice and stated action uh, should be declined. A question clearly stated the audit firm were appointed to provide corporate finance advice to the acquisition of the target company. At that point in the process, the audit firm were not auditors, they were appointed auditors following the acquisition of a target company. So that's it. So this was the mistakes, mostly mistakes made by the students, which caused them a failure in the exam. I suggest you to improve them. And if you have any question, any questions, you can ask me in the comment of the video. Also, you can contact me on +92334177 77706 on WhatsApp with your queries. Also, you can join accountancy.com online classes to increase your pass chances, to increase the exam techniques, which can help you pass the exam. Uh, Till then, take care. Bye bye.